Federal Reserve concluded their FOMC meeting on Wednesday, May 3rd, releasing this press release, this statement about monetary policy moving forward. We're going to take a look at a couple notable changes here because it's the changes between last FOMC statement and this one that really highlight that the Federal Reserve is most likely done hiking interest rates. Markets are not yet in turmoil, so if this is true, this could signal the calm before the storm. Take a look at some of these changes. The first one here, in the last statement, it said recent indicators point to modest growth in spending and production. And instead of saying that, this time they said economic activity expanded at a modest pace in the first quarter. So last time they were saying, looking forward, we expect modest growth in spending and production. Now they're saying, hey, looking behind us, we see economic activity expanding at a modest pace. So nothing about that continuing or expanding into the future. So that's a big change. They're saying, hey, that growth is behind us. Another thing they said, job gains have picked up, which indicates increased. But this time they said job gains have been robust, which just communicates, hey, they've been, somewhat the same. They haven't dropped off of a cliff, but they haven't been picking up. Now, this next change, I think, is the first most significant change between what they said last time and this time. So last time they said recent developments are likely to result in tighter credit conditions for households and businesses. So they are looking ahead at that and saying, hey, a couple of things have been happening, and we expect that that could result in tighter credit conditions. This time, they completely eliminated that first part of the phrase, and they said tighter credit conditions for households and businesses are likely to weigh on activity, hiring, and inflation. So the thing that they're looking forward to is what those tighter credit conditions are going to do. So they're saying that they're likely to weigh on economic activity. But the tighter credit conditions are here, and they fully recognize that. And that's something that they're 100% accurate about. When you look at credit conditions, when you look at interest rates on debt, when you look at banks pulling back on lending, when you look at access to loans by small businesses and households, we absolutely right now have much tighter credit conditions. And so they're recognizing that and saying, hey, this is going to weigh on economic activity like hiring and also inflation. This is a very deflationary, this is going to have a very deflationary impact on the economy. Kind of the same thing here that they're saying, the growth happened in the past. So right now we're looking at things that are going to be weighing on growth. And then they also say the extent of these effects remains uncertain, because last time they said that it is uncertain. So they're just saying that that part hasn't changed. Now, the next change here that they made from last time to this time, I think, is the second most important indicator of the future of monetary policy here. So last time they said the committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return to inflation of 2% over time. In determining the extent of future increases in the target range to return inflation to 2% over time, they'll take into account all the cumulative stuff. So you can see they scratched out a ton of that. And the only thing they said this time was, in determining the extent to which additional policy firming may be appropriate to return to inflation over to 2% over time, the committee will take into account these things. So instead of saying, hey, we think that in the future some tightening will be necessary, they're saying now we're just figuring out the extent to which additional tightening may be appropriate. And they also took out this part that said, in order to attain a stance of monetary policy that is enough to return to low inflation. So they took that out. Basically, they're signaling we have achieved monetary policy that is restrictive enough to bring inflation down. Now we're just trying to wait and see how long we keep it here, because everything they're saying here is extremely negative about the economy. The growth that happened was in the first quarter, no longer now. Tighter credit conditions are here. We're just trying to sit now and see, hey, how much negative impact on the economy will these conditions have? Our monetary policy is already restrictive enough to bring inflation down. What effect is that going to have, and how long are we going to sit here? So this is a very deflationary outlook that they are giving here. You always have to read between the lines, because the Federal Reserve never wants to just come right out and say, hey, things are going to start crashing here. They're never trying to spook the markets. They're always trying to be very careful with what they say. So you have to read in between the lines. And when you look at and compare the changes from last statement to this statement, you see that very clearly. Next thing I want to show you is the yield curve. So the impact that this had on rates. There hasn't been a huge impact on yields. But one thing that is very important to look at is down here. This is the yield curve. And so right here, you see the 1 month is at 4.5%. Right here, you see the 2 month is at 5.3%, and then it goes down from there. So this is an example of an extremely inverted yield curve, where the shortest end of the curve has the highest interest rates and the long end of the curve has the lowest interest rates. This is not something that you would expect to see if the market was pricing in growth. This is the market pricing in a collapse. This is the market pricing in that the Fed is done hiking interest rates, that the highest the interest rates will be are in the near-term future. And going forward, the pain of the economy is going to be bringing prices down so quickly that the Fed will have to lower interest rates, or that the Fed will be able to lower interest rates again because we'll have deflation instead of inflation. So this is a sign of a recession. The inverted yield curve has preceded every single recession for the last 50 years or something, maybe even longer than that. It might be 60 years. So the inverted yield curve is something that is a very strong indicator of economic pain to come. The last thing I want to show you today is the reverse repo facility, because this is something that I always keep an eye on, and I know you guys are constantly keeping an eye on as well and asking me about. This is the reverse repo facility. And you can see here, ever since about June of 2022, so almost a year now, there's been no change in the range that the reverse repo facility sits in. Yes, it goes up and down in this range, but it really stays in here at around that $2 trillion mark. So $2 trillion is sitting in the reverse repo facility, and that isn't really changing here. The reason for this is because if you look at the implementation notes, on what the individual changes are to the rates across the board, you see here that the Federal Reserve is going to be conducting reverse repurchase agreement operations at an offering rate of 5.05%. Now that 5.05% is significant because it's 0.05%, which is 5 basis points above the bottom end of the target range for the Fed funds rate. And this is what the Federal Reserve has been doing ever since here. When money first started to flow into the reverse repo facility, it was because the Federal Reserve decided that this reverse repo facility was going to pay 5 basis points more than the Fed funds rate. Before that, it didn't pay anything. It was a zero rate. So the Fed wanted money to come in here to help out with bank balance sheets because of the way that deposits work in the banking system. So they wanted money to be in the reverse repo facility. It helps with tightening conditions because if money is in here, that means that those dollars at the same time are not in here. These are U.S. Treasuries. And so banks need collateral, and so they would take their trillions of dollars and they would go buy collateral from the open market. That would push rates down. When you buy bonds, that pushes rates down. And so instead of having that happen, which is stimulative when rates go down, they wanted rates to go up. So they don't want that money out there in the open market being lent out. And so they suck that money out of the market into the reverse repo facility here so that it stays out of circulation, so that those dollars are in this facility. And in order to do that, they have to offer a significant rate there. So 5.05%. Why is that significant? This is the only place that you can actually get risk-free money. Like literally risk-free. This is the only place in the world that you get risk-free money. And so like when the typical treasury is considered risk-free, the risk-free rate, the 10-year treasury, the United States government, they're not going to default, right? Well, there's always the chance that they default, especially with the debt ceiling thing going on right now. There's the chance, it's probably like zero, close to zero, but there's always the chance that the politicians get a little bit too angry at each other and don't want to budge and want the other side to budge, so they feel that they got their way, so that they appear stronger, and neither side budges, and boom, the deadline passes and the US defaults on its debt. Like, that's a possibility. But with this, the reverse repo facility, all they do is they have a computer program that prints out the right amount of money to pay 5.05% on this $2 trillion. And it just does it. It's just printing the money to pay to the banks to hold the cash there. And so this is the only place to get actual risk-free return, is the reverse repo facility with the Fed. Whose money is this? This is money market funds. And so when you take a look at most money market funds that are just regular standard money market funds, like Fidelity has one, Vanguard has one, Schwab has one. These are through brokerage accounts. You put your money in this, and a lot of that money is just going into the reverse repo facility here. And the money market fund gets that, 5.05% now. And so the rate that gets paid back to you will probably be, 4.75 or 4.9%. And then the money market fund just takes that little bit of a difference in order to fund keeping the money market fund rolling. And so this is why I say that money market funds are like one of the best places to keep cash right now, because you don't have the counterparty risk of the bank going under. When you put money in a bank, you're just loaning that money to the bank. And so you're a creditor to the bank, regardless of what they do with it. So you're taking on the counterparty risk of loaning to the bank, and then the bank has the counterparty risk of whatever they choose to do with it. Like if they choose to loan it to the US government, then they're taking on that risk. And so you have multiple levels of counterparty risk, and you're not an owner, you're a lender, you're a creditor there. But with a money market fund, where most of it is being passed through to this reverse repo facility, it's like the risk is far less, the number of counterparties are far less, and the return is way better. Like most banks are paying like 0.1% to maybe 1%, 1.5%. Even like the brand new Apple savings account is a high yield savings account inside the iPhone, and it's like what, 4.5%, 4.8%. And so you can take on less risk and get a better return with something like a money market fund that's just getting paid by the Federal Reserve through the money printer. And so that's significant, that's staying. And this is what I'm watching when they decide to shut this off. When the implementation notes, maybe at the next meeting or the meeting after that, if this thing goes down and it matches the bottom end of the range of the Fed funds rate, or maybe it moves a little bit lower, suddenly then all of this money at some point will start to drain out of the reverse repo facility. And I expect, I've been saying for about a year and a half now, that's going to be the first pivot. They're going to drain the reverse repo facility before they actually pivot with the Fed funds rate, before they start up QE again. They're going to use the reverse repo facility first because it's a lot less understood, a lot less visible. And so it won't look like they're blinking. It won't look like they're pivoting. They'll be able to save face and maintain confidence that they know what they're doing, maintain that credibility in the public eye if they use the reverse repo facility first before they pivot with their other tools. So we'll see. I'm still watching that, but they haven't done it yet, which indicates to me that we have a little bit longer to go. The pain has not yet set into the point where they are fully pivoting, but they have indicated that they are done hiking or close to it, and that we have deflation ahead of us and all the growth and good times are ahead of us, or we're behind us, and the yield curve is matching that as well. So that's what I'm watching. Thank you so much for hanging on there. And if you would like more education, if you would like courses on the courses that I teach on financial literacy, whether it's portfolio allocation, basic fundamental analysis so that you can invest during bear markets and be able to buy stocks at discount prices that are good stocks, good quality companies, but you know you're getting them at a price that is actually fair value or under. Or if you want to learn how to trade options, like the professionals trade options strategy the professionals use, so that you don't get stuck, losing a couple $100,000 on puts on First Republic Bank, like that guy did. I was going viral on like Reddit that he used puts to bet on the collapse of First Republic Bank, but he did it with Robinhood, and even though he was right and he should have made a lot, he ended up actually losing it all because of the way that Robinhood operates. So if you don't want to do and get stuck like that, you want to use the professional option trading strategies and a bunch of other stuff that I've learned over my career. I teach it all in my Heresy Financial University courses. You can sign up for a membership with the link in the description below. As always, really appreciate you guys. Thanks so much for watching. Have a great day.